Welcome, everybody. I'm Dana Keep. As Becky said, we are thrilled to have Jamie Easton with us today to talk about a clearly very topic of high interest. Jamie has nearly 20 years of professional experience in the financial services industry, and now she is the founder and CEO of the financial media company called The Uptick. And we are so grateful that you are here to share your experience and expertise with us, Jamie, and we look forward to it. So thank you so much for joining us.
Great. Thank you so much for having me. I'm thrilled to be here with a fantastic group of Wellesley alumni. So this is very exciting to do this afternoon. And I want to give a special thanks to Dana and Becky for inviting me to speak to the group today. So let's talk about a topic that most women tend to avoid, and that's the topic of money. So I'm going to share my screen with you. See if we do this. Okay, perfect. Hopefully you all see this, and let me just do one quick thing. And of course, hold on one second. All right, I don't know that we're getting to the full screen, but that's okay. You hold on. All right, here we go. There we go. Does everyone see that now? Great. Okay, so there is actually no better time than today to talk about this because we are closing out April, and April is Financial Literacy Month. So we got this in right under the wire. You know, we'll talk a little bit about why I'm so passionate about financial literacy, but when I think about our whole educational journey, you know, we learn so many things, right? We learn how to read, we learn how to write, we learn how to analyze data, we learn how to master or try to master geometry. Nowhere in traditional education, though, is there really room for financial literacy. So I think a lot of us get very far into our careers, or we start off our careers and we turn around and we say, well, how do we even learn about money or investing? Because we never learned about it in school. Well, unfortunately, we actually have to learn and train in real time. And you know, it's once we have money, that's when we have to figure it out. Not the best, but you know, it is April, so we'll embrace the topic and it's never too late. So the best news though, before I start that, is that, you know, many of you, not all of you, still have your peak earnings years ahead of you. So, you know, the whole key to financial wellness is to really start early. And I know some are a little later in your careers, and that's okay too. But if you can save and invest early, it is better because of a little friend that we'll call compounding. And we'll talk a little bit about the power of compounding and how to make your money work for you. Having it, the earlier you start, the better. If you are a little bit later into your career, it's still not too late. It's just not as powerful of a friend, that power of compounding. So we're going to do a couple of things today. First, I'll tell you a little bit about me and how my business, The Uptick, came to be. We'll also focus on why I'm so passionate about financial literacy and why it's really important.
I can't hear anything.
You can't hear me?
Well, I can hear you just fine.
Okay. I can move the speaker a little closer. Can you hear me now? Is this better?
We could hear you before. I don't know why she can't hear you.
Yeah, I think it's something on her computer.
Got it. Okay, perfect.
I
So
can't hear.
Carry on.
Great. So we'll talk also about how to get started in investing, because I think that a lot of my questions always come of how do you even start? And then we'll talk about the markets right now and what's going on. I'll also try to leave you with some takeaways and some tips as well. So this is me. I am Jamie Easton. I'm founder and CEO of The Uptick. It's a media business really aimed at empowering women to better understand business and finance. I spent a 20-year career on Wall Street before becoming an entrepreneur. I graduated from Penn. I joined Goldman Sachs right out of college. I was a junior analyst in equity research. And I spent the bulk of my career really in equity sales. And it was working on a very fast-paced and energetic environment on a trading floor. I was fortunate enough also towards the end of my time in investment banking to run an investor relations division of a publicly traded investment bank called Evercore. And I absolutely love my time on Wall Street, but I had this burning passion to do more around the whole idea of female empowerment and financial education. So ultimately, I wanted to impact how women interact with business news. I was very, very involved in my time on Wall Street with doing mentorship and different women's initiatives. But it really, to me, I was helping women in finance stay in finance. And I wasn't really doing anything about all of those women who weren't in finance and how do we actually change the future. I was at a dinner party in early 2019 when this idea came to me. I just kept noticing time, and it was years of noticing.
I can't hear anything.
It was years of noticing that, we would be at a dinner, and the second a topic in finance or business news came up, a lot of the women at the table would turn and say, "So what else is new?" And I realized that women still just didn't feel confident enough to participate in a conversation about finance. So I did some digging and I probed and I would ask questions like, why is this topic so scary? And I would hear things like, oh, I'm bad with money, or I was an art history major, finance isn't for me. So that really fueled my passion to do something about it. A year ago, I launched the Uptick newsletter, and I take business news, I make it more relatable and accessible. And the whole idea behind it is the second you embrace the topic about conversing in finance and business news, it's going to open up doors that ultimately impact your financial future. And we can get into that a little bit. So why is it so critical to be financially literate? It's actually shocking when you look at the data and you see how are women doing relative to men. So women account for 51% of the population in the US, but when you look at surveys, 26% of women have money invested in the stock market compared to 60% of men. So in fact, 65% of women have a large percentage of their money in cash. So, and 41% of women have no plans at all to invest that cash. So is that a big deal? It absolutely is, and we'll talk about that. But let's look at some of various investment alternatives. What are we presented with as alternatives to keep our money? So here are common places to put our money. So the first one we'll talk about is under your mattress. And this is really, and I don't necessarily mean under your mattress, I mean sitting in your wallet, not even in the bank, but keeping it stashed somewhere at home. Is this a good investment option? And I hope we can all agree it is a horrible investment strategy. Why? Because you have $100 at the end of the year. Hopefully, if you don't lose the $100, you'll still be sitting at the end of the year at $100. The downside to this investment strategy is, a lot of us will misplace that money. So then there's alternative 2, which is the bank. On the positive side, right, money that's put into a checking account, a savings account, or even a CD, it is safe, it is FDIC insured, you will get that money. It can't be misplaced like the $100 under your bed. That said, if you look at what the national average interest rate is on a savings account, it's about 0.05%. So that means if you had that $100, you turn around at the end of the year, you will have $100.05 by April 28th, 2022. So is that a great place to keep your money? Still no. Now, the next option is bonds, and investing in bonds has been slightly better than keeping your money in the bank, but it still pales in comparison to stock returns. Bond investments have yielded about 5% over the past 10 years. So definitely better. And now let's look at stocks. So stocks are the most alluring, the most exciting of the group. And it really made me so passionate about pursuing a career in Wall Street because I was always driven to that excitement about stocks. So yes, it's exciting. Yes, it's fast paced. Yes, it's high energy. It's what you look, when you turn on CNBC and you read the paper, it's always talking about stocks. Looking at data over the past decade, the annualized stock market return has been about 14%. So definitely a lot more compelling. If you want to go back further than that, and we want to look at stock returns over the past century, it's been about 10%. So yes, some years are down, some years are up, and 10% can absolutely not be expected with any certainty. But stocks are about just the best place for, and I'm going to reach out to those younger investors, for a younger investor to put their money. That is one of the best spots because you have that ability to hold the money there for the long term. So to add some perspective, let's talk about had we have taken $5,000 and put that into these various alternatives in 2010, where would we be today? So the stock investor would be sitting with over $18,000 today, which is, wow. I mean, that is a great return on your money. Why is that? Because of that power of compounding. You're getting these returns, reinvesting the money that you made, and you get to $18,000. The cash investor would be sitting with nearly $5,300, and the bond investor with a little over $8,000. So stock returns are volatile. They can vary widely from year to year, but over the stock market, over the long term, the stock market really has far exceeded the performance of most other asset classes. Okay, so given all of these alternatives, we're still seeing that women are steering clear of stock investing relative to men. So women are clearly missing out. And our reluctance to invest does impact our financial futures. And what ends up happening to women is you have this investment gap that we talked about. You compound it with the gender wage gap, right? If women make 82 cents for every dollar earned by men, and that's in the best case scenario, and that number goes down for minority women, that leads to women only realizing retirement balances that are half the size of men's. So that is, really a disservice to women who have not invested early on, when they turn around and they're trying to retire, right? There's this big mountain to climb. So if it makes so much sense when you look at historical long-term returns, why do women stay away? So there's an adage in finance, and it says, women save and men invest. And I find that to be really interesting to hear because I do see that, anecdotally in my life, right? Women save, men invest. I have no idea when this was first said, but I do know that in 2021, it still rings true today, and this adage is not written in recent time. I think that most women do crave certainty, especially when it comes to their hard-earned money. So you hold cash in the bank and there's no risk. Treasury bonds are backed by the full faith and credit of the US government. Real estate is an asset that it's easy to see. It feels less risky because it's tangible. And the stock market, particularly in the short term, is fraught with higher risk. So, what women do have to do is be willing to invest in the long term and remain steadfast. Women, interestingly, happen to be incredible investors, and relative to men do see higher returns, and that's even on the professional level. So I find that it's just interesting to note. Women are incredible investors. They do just need to trust themselves a little bit more. To many women, the stock market just seems inaccessible, and it's filled with a lot of esoteric terminology, and it becomes this unspoken barrier to entry. So, when a lot of people pick up the paper and they're saying, what am I going to read? The US dollar continues to free fall following a dovish Fed and Powell urging fiscal action is just not the first story that most people gravitate to. It's what is a dovish Fed? What is fiscal action? What are these terms? And is this something that I actually want to dig into? It feels like if you're not in the know, that these articles aren't welcoming you. Although investing does come with its own lingo, investing does not need to be complicated, nor is comprehending markets as hard as it sounds. And there are several resources available to support you on this journey, and hopefully one of them will be also the uptick when we're finished with today. So here's the good news. The good news is business news and understanding finance doesn't need to be complicated. You do not need to be a millionaire to invest money in the market, and you don't need to be a financial genius to buy stocks or bonds, but you do need to learn how to invest. So my advice always, the best way to get more involved in the markets and to become more engaged is to get some skin in the game. So even owning a share of something will force you to pay attention more. It's going to help you learn more. So I'm encouraging you all today to go out and buy a single share, 5 shares of something that you find interesting, that's yours and yours alone. And this does not have to be something that you pour over this decision, because you're not making a huge investment in this stock. It should be something that you find, it's a brand or a company or something that resonates with you, that you're going to find interesting enough to say, hey, you know what? I actually like this company. I'm going to dig in here. And then you'll see what ends up happening. So let's say, you decide to buy a share, 5 shares of Apple. The second you see news come out on Apple, you're going to say, hey, I invest in that. I'm going to read. I'm going to start learning. You walk past your TV and something's on CNBC about Apple. Trust me, you're going to pause and say, oh, wow, I didn't realize they reported earnings. What is the company saying? It's really your gateway to start learning. And the second you buy one stock and you say, okay, I kind of am understanding how this is trading or what's happening, how does the stock react to news, it will get you to feel a little more confident, and maybe that will help you buy more stock in something else. So this strategy is not going to make you a millionaire. It's just simply about getting your head in the game. It's also not the strategy that I would say, this is not what you're doing with the bulk of your money, and we'll get to that. That said, you're not going to invest money that you're unable or unwilling to lose, and do not expect that this investment is going to go straight up. Stocks fluctuate. This is just a small investment that you're making for the long term. And then what do you do? I get these questions, but what do you do with the bulk of your money? Okay, so while I love the idea of focusing on this single stock to help you engage and learn, beginner investors want to invest a larger percentage of their money in a more diversified way. One of the best ways to do that is through index funds, or what I tend to invest in more are ETFs, which are exchange traded funds. So index funds and ETFs involve investing in an underlying benchmark index. So you own really a basket of stocks that mimic a certain index. So let's say we take the NASDAQ 100. So the NASDAQ 100 includes 100 of the largest domestic and international non-financial companies that are listed on the NASDAQ stock market. So this is Apple and Amazon, Google, Facebook, Tesla, 95 other companies that make up this NASDAQ 100. Now, instead of having to own stock in all of these, you could say, you know what, I'm going to be more diversified. I just want to own all of them and a little piece. So you could buy something called the QQQ, which is an ETF. It trades just like a stock, and it gives you an exposure to a group, a basket of all of these companies. So the best way to really invest is really to buy things like indexes or exchange traded funds and things that you don't have this single stock risk. However, anyone that really buys exchange traded funds or index funds doesn't start to learn how these companies individually trade or how they react to news. They're owning this basket. It's a great great investment strategy, but not a great teaching tool. And then while you've probably heard a lot about mutual funds, these are a little bit different. Mutual funds are actively managed by a team of finance professionals, and they're all working to beat the index, right? So they have benchmarks that are tied to the index. An ETF and an index fund is going to look like an index. A mutual fund is trying to beat whatever they're trying to be tied to. It is the most popular investment choice in the US. I think at the end of 2019, mutual funds had about 21 trillion of our assets, and about 4 trillion are in ETFs. The problem with mutual funds, and they generally come with high fees, and passive investing, which is ETFs and indexes, are called more passive investments because they're not managed by these finance professionals. The passive investing generally does better almost all of the time. So there was a report out by S&P that cited that 92% of active managers at large companies were unable to beat the market over a 15-year period. So so why pay the fees? That's why I think that diversification, we'll stick to ETFs and index funds. So now let's get back to our single stock pick. So what should you pick for the single stock if you don't know much about stocks? Well, here's more good news for you, is that you probably know a lot more than you think. You possess enough knowledge right now to actually invest, okay? So when I first started out in equities, I had a really hard time figuring out why stocks really trade. And I asked my boss at the time, and he said to me, well, stocks go up because there are more buyers than sellers. Stocks go down because there are more sellers than buyers. Okay, you know what? I hear you. Does that really help me? No. Definitely a true statement, unhelpful. So a lot of stock movement is about the fundamentals. Those are the financials. Those are things that you hear about, which are the revenues and the earnings, profit margins, all of those terms that sometimes keep us out of investing because it seems like it's a little complicated. But that's not the total picture. The second part are technicals. You sometimes hear the 50-day moving average. You hear all of these other terms, and you again, a lot of us say, this is now not for me. What technicals are is looking at stock charts and saying, you know what, if we look at how things have traded historically, it will influence how stocks perform in the future. So still, is this a good investment strategy? Some people do it, some people really like it. However, while most professional investors focus on number one and number two, what they're missing oftentimes, and this is what you have, is sentiment. And sentiment, that is how are people feeling about a stock? What does the group think around it? It's really understanding the perception of that company. That's one thing that I think people miss. And in my view, it can be one of the most important. So sentiment is also an area where you can do your best investigative work, right? You can start paying attention to the brands and companies you interact with every day, and you start thinking of them as businesses. And then you think about what your peers are saying about these companies. I like to give this one quick story. I used to work with a very famous footwear analyst, and he was one of the best stock pickers I had ever encountered. And I said to him, John, how do you always pick the best stocks? You're so good at it. And he's like, oh, it's easy. When everybody rides the subway and they're looking out the window, I'm looking down to see what people are wearing on their feet. Simple as that, right? So all of the young kids come in, they've all switched to Nikes. I feel like it's time to buy Nike, right? And he made a career of being able to spot trends and invest that way, and he was spot on. So that's what I mean by you already know a lot more than you think. And if professional investors, if it was just on the fundamentals and on technicals, Professional investors would be right 100% of the time, and they're not, right? So clearly there's room for your investigative work to influence how these stocks actually trade and perform. And that's why I think you should feel very confident expressing your opinions about stocks. So let's talk about a couple of stocks. I always like to give some examples. So let's talk about Disney. We saw Disney, if you look early in the stock chart, that's a year ago in April. You know, things were pretty doom and gloom for Disney, right? Their theme parks closed. We were all locked inside. You know, why invest in Disney? So Disney Plus launched in November 29. In March and April, people started running out of entertainment options, and it looked like this pandemic was going to go on for a lot longer than we had thought. So what did a lot of parents do? They started signing up for Disney Plus. So, okay, fine, we'll entertain our kids with Disney Plus. Disney Plus started to experience incredible growth. And you could have seen, there were articles about it, that Disney Plus is now catching up to the size of Netflix. So Disney Plus, impressively, now has over 100 million subscribers in their 19 months, versus Netflix has almost 200 million, but it's 13 years in the streaming business. So that's incredible, right? That is absolutely incredible. And we heard all of these stories. And then you can see how Disney started doing as we go through the year, as all of these metrics started being announced, right? You look at the stock performed very well through the summer, incredibly well. And then what started to happen? What started to happen is what created this unbelievable rally, even after we knew that these Disney Plus subscriber numbers were so good, is starting in November, we got some news that the vaccine was coming. So now all of a sudden, what should trigger in your mind? Well, the parks are eventually going to open, and the parks are a big part of Disney's business, right? So once hearing that, people started clamoring for Disney, and Disney reached all-time highs. Could you, when you think about that stock story, and I like to think of stocks as stories because it makes it a lot more fun, could you see from that story exactly why Wall Street got so excited? And you could also see that you didn't miss it. Even if you were late to this story of, reopening, getting vaccinated, getting the stock, getting the parks back opened, you still could have invested in Disney in November, in December, in January, and still actually had a great investment. So a lot of times people try to time the market instead of investing in the long term, and that timing never works out. So if you believe in something long-term and you believe that, okay, I understand that this is what's going to happen and this is how mainstream news is influencing Wall Street, what could it mean for this stock? You kind of have to start thinking a little bit further down the road. So let's do one more example. I always like to use Zoom because we're on Zoom, and I think a lot of our lives are still based around Zoom. So we look at Zoom. What did we know about Zoom 1 year ago today? And you can see it early here on this chart. We were just starting to get comfortable with it in last April. By July, we were probably all of our social activities transitioned fully to Zoom. And everyone you knew started using Zoom as a verb, right? When companies become verbs, probably onto something, right? So now when Google it, now we're gonna let's Zoom later. So still, if you had said, you know what, this is going to be a big thing come July, August, September, we found out we're not restarting school again, right? So that still would have been a great time to invest in Zoom. Then you get towards that November date and you see that, the stock started acting a little more sluggish. And what started happening again, we started hearing word in October, November, vaccine is coming. And then people started to contemplate how does life actually work with Zoom in the future? So one of the things that we have to think about is the market is always forward looking. The market thinks 6, 9, 12 months ahead. It doesn't look at right now. So if you're looking at what do things look like right now, you kind of miss it. If you look at how our stock's going to do a year from now. So when you look at Zoom, an investor having that investor mindset will say, let's imagine we're doing this event 1 year from now. Are we doing it still on Zoom? Maybe. I think, Zoom has definitely entered our lives in really positive ways and given us great access. Will we be using it quite as much? Probably not, right? So I think that those are some of the things that investors and having that investor mindset will give you that ability to form real opinions about stocks. And then the other one I always also like to touch on is Peloton, which was one of those pandemic darlings that everyone needed to own. The stock, if you look over the past 3 months, it's down over 30%. So, maybe that's Wall Street saying, okay, well, I think people want to do group fitness and maybe it's not going to be on the bike anymore. So let's just talk about where we are now in the market before we open it up to Q&A. The markets did experience this incredible rally. And what does it come down to? So it absolutely is because of all of this fiscal stimulus, all of the government support, the support from the Fed. But really also what you need to understand is that a lot of it was just driven by optimism, by all of this optimism that the world is going to quickly resume some sort of normalcy, and it's going to happen faster than we thought. The other thing that's driving the markets today is that there's so much pent-up demand, right? There are a lot of people that are armed with stimulus checks or have saved at a higher rate than they ever have because they stopped traveling, they stopped dining out, they stopped spending money on entertainment. Where are all of those dollars going? Some of them are going into the stock market. Some of those dollars people are waiting to do and go and travel and do things again. And, your job with this investor mindset is to figure out, what happens 12 months from now. And some of the trends have already really started to happen, right? If you look at airline stocks over the past year, they're all up over 100%. So your job with that investor cap on is to think about, well, what's next, right? If we know that and bookings are already there, what's the next thing that people are actually going to get excited about and think about? So also, why should you care? So a lot of people will also ask me, well, that's great. The pursuit of returns is great. And being involved in conversations about finance is also great. But there is another, I would say, benefit to starting to follow markets and trends. So one is, you don't want to be presented with opportunities now or in the future at work with things like, investing in a 401k and having the opportunity to invest for retirement and opt out because you don't feel confident enough to actually do it. Your workplace might be a publicly traded company. Are you actually following earnings of that company? Are you listening to the company conference calls and hearing what is the management team talking about? Are you in a division that they really care about? What are investors asking about that company? It makes you a better employee. If you're working for a private company, following the earnings and the calls of your publicly traded peers is also really, really important. Understanding what people are saying about them, understanding the sentiment about the industry, all very important things to pay attention to. Then I also do get a bunch of questions about how to even find the money to invest. I know you're all at different points in your career, but all of us probably make mistake number one, which is not canceling things that you stopped using. All of that money that you're just really throwing away by forgetting that you signed up for an Audible account at the start of the pandemic, but you haven't listened to a book in, since last April. Maybe it's time to cancel that. You've just found yourself $9.99 a month. So all of those things were all unfortunately, I think a lot of things get lost in the shuffle because we don't pay enough attention, but they do add up. And I unfortunately realized during the pandemic that I bought my son a copy of Captain Underpants in 2014, and I've been paying for that book. You know, I spent close to $400 in that book because I forgot to cancel it over all this time. So was that a mistake? Absolutely. However, I did call Amazon, and Amazon was willing to give me back more than half of the money. So it's always worth advocating and trying to, you know, when you do make those mistakes, trying to get that money back. It would have been definitely better, well used, if I took that $400 and saw that the Dow was at 18,000. That would have been a better place to keep that money than at Amazon. The other tip I'll give you, and this is good for any point of your career, is take money out of your paycheck before it even hits your account. So starting with my first job out of college, as soon as my money was direct deposited, I had another account that grabbed $20 and put it into a different account. I never saw it. As I got more senior, that $20, you know, raised to $50, raised to $100 to $250. And really, as you move through your career, you should be taking the money out to actually save it. And I think I call it forced savings, but it's very important to do that forced savings. With my forced savings that I then invested, I was actually able to, it ultimately became the down payment for my first apartment in New York City. It does absolutely work. And then I will just leave you before we open this up to, it's a quick story that reinforces these gender stereotypes about investing and why it's really in your hands to change. About 18 months ago, I was actually at a small hotel gym, and I get on the treadmill, and there was already a man on the treadmill next to me. He was watching CNBC. I was really excited because I actually watch CNBC a lot of, like, every morning I start my day with Squawk on the Street. It's my favorite show. The second I started my run, the man took the remote and he turned off the TV and he said, "Sorry, I didn't want to bother you." I said, "Oh, okay, how is that bothering me?" And he's like, "Oh no, you wouldn't care about, I was watching some stupid business show, so sorry." And I said, wow, you know, if we can't, the only way that we can change the way that men perceive us as investors and engaged stock market participants is by joining these conversations, or this is going to happen generation after generation after generation, that, you know, men have these preconceived ideas that, you know, don't bother someone about anything financial. So, you know, I will encourage you, as you know, to spend the rest of 2021, you know, we always end the year with a favorite book, a favorite movie, what about a favorite stock? We all left this year with a favorite stock that we could actually join a conversation and talk about it. Hopefully, you know, we'll never say that we're not good with money, or, you know, not want to be an active stock market participant, or at least talk about it. So thank you so much for joining today. Hope you will subscribe to my newsletter. It's theuptick.net. It's weekly, comes out every Saturday morning, and it will hopefully help you become more conversant in stock investing and markets going forward without all the jargon. And now we can open it up to some questions. Actually, before we open up to questions, I did get a few questions before the event that I just want to address, because I think a lot of you had questions about what do I do in terms of percentages of how much do I even save for retirement? Do I pay off my student loans? So I'll give you a couple of quick basics. The general rules behind spending and saving and investing are that you need at least 3 months of expenses as an emergency fund. I'm much more conservative. I like to have a year of expenses. I think some people would say, like, that's crazy, but it's just the way that I can sleep better at night. But the general rule is that 3-month rule. The other thing is, how much of your income do you save for retirement? the general rule here is about 10 to 15% of your income should be saved for retirement. It tends to be less in early years because you need more of that money to actually live and pay your bills. So I'm not saying to you have to do that because you need to pay off your credit card bill every month. So do not invest for retirement and have outstanding credit card bills that you need to finance, because usually those the interest rates on credit cards are very, very high. The leftover money is for paying off your student loans or investing. And how do you decide? Well, you decide because you have to look at the interest rate. If the interest rate on your loans is 5% or lower, then I would say invest the money, because you'll probably have over time, you'll be able to generate more by investing. If it's above, then it probably makes sense to pay off those loans or refinance. So that's kind of, those were some of the broad things that people ask, but I'm happy to take any of your questions. Let me stop this.
Thank you so much, Jamie. That was a lot to cover, and
It was a lot of information.
But the slides are very helpful, and I'm imagining if you can share those slides too, that would be helpful later when we do.
Oh, absolutely, happy to.
We did have a number of questions, and there were several along the lines of could you please discuss the ethics of investing in the stock market, and that broadens into ethical investing, conscientious, social, environmental investing. Do you have tips for that?
Yeah, I feel like there are so many companies that are doing great things, and there are ways to tell. There are metrics, ESG, environmental, social, and governance, and there are metrics that you could actually look at how these companies score on all of these factors. It is becoming more and more popular to have this ESG mindset with investing, and I am all for it. And I think it's especially attractive to women, especially to younger women who get very excited by ESG investing. If you actually look at how companies do, like I've read a bunch of articles around Earth Day to see, how do companies that have good ESG practices, and this is focused on the E, the environmental, do relative to their peers with worse scores. They actually do perform better, which is actually great to see that companies, and this is a very generalized and broad statement, but overall, those companies who do pay attention to those factors do perform better. So I do like when that does happen. There are also ETFs, and there are ways to play it through different ETFs that you can do, like more diversified investing in ESG companies. So I would say to do your research, look at those ESG scores. And I think it's absolutely a phenomenal investment decision too, because if you're passionate and you believe in what the company is doing for the long term, and you believe in their ESG practices, then I would say go for it.
That's great. Here's a group of questions that have come in are somewhat related to that, because you want to be doing your research, but just even at maybe a more beginning stage, how do you think about which companies to begin with, like Vanguard, Robinhood, Public, to get your information and to begin
trading? And I get this question all the time. I think that you can actually choose any platform that doesn't charge you fees for trading. So I personally, I use Schwab. I think Public is great. Robinhood, I know, does attract a lot of the younger investors. The only thing you have to be careful with is that you don't get yourself into trouble early on, because I think a lot of companies will try to get you to buy on margin and do things that if you only intended to put $500 in the market, but they're giving you this leverage that allows that $500 to become $2,000, right? There are all these things that you could get yourself into trouble without really trying to get yourself into trouble. So keep it simple, especially in the beginning. And if there are fees, high fees associated with your investing, that's an absolute no-no. Something's wrong there. So Ameritrade, Schwab, Robinhood, all of the big name investing platforms should allow you to trade for free. And part of that is thanks to Robinhood, because when Robinhood did come in as this disruptor, it made all of these other bigger online brokerages fight for share and cut all their fees. But I'm fine with anything. And I would make it easy for yourself. Do something that has a really good mobile platform too, so you can check and stay informed.
Good. Also, Ellevest has been brought up as particularly for women focused investing. Do you have thoughts on? Yes.
Yeah,
no?
you know what? I do. And the only thing I will tell you is what you don't want to do too much of. And I think that there's definitely room to, I think that it is great to cede some of your control to having other people manage your money. And that's absolutely great. And I'm all for supporting women brands and women empowering businesses. I think it's phenomenal. And I do think that sometimes having professional investors watch out for you is great, but I don't want you to ever lose having some ownership of your own financial journey. And sometimes, having a dual approach could be fine too. And using, a financial expert for some of your money is fine, but ceding control, I think, is where a lot of us get into this cycle where I don't know, my financial planner does that, or that's not for me. So I think part of this is hoping that you take some of that ownership and say, sure, you can have this percentage of my money, but this I'm saving for myself. And this I'm going to invest in my own stocks, and I'm going to invest in my own ETFs and index funds, and you can have the rest of it. But please do that, because then I feel like that whole cycle never gets, sure, you are invested in the market at that point, but your mindset never changes, and you're never empowered to really start forming real opinions about stocks and business news.
That's a great recommendation. I've seen a couple of questions about IRAs as well. At what age, how much, thoughts, your opinions?
Yeah, I think that's great. Some companies offer 401ks, some do not. But I think saving for retirement, and we'll just generalize that, no matter how you invest for retirement, if it's through an IRA or a Roth or a 401k, it's really important to do as early as humanly possible, right? And I think that sometimes those first, let's say you're 0 to 5 years out of college, it's sometimes hard. I will tell you, when it becomes, I think, a real loss to not do it in that 0 to 5 years out is when your company provides 401k matching. So sometimes you'll see that we match what you put in. Why is this important? It is free money. So you are saying no thank you to free money. When you invest in something like a 401k, it's really, you're taking your pre-tax income and you're putting it away for retirement. So it's going to reduce the amount that you actually pay. Your taxable income goes down. So when it's time to pay taxes, you have, you're getting taxed on less money because you invested for retirement. So there are all of these benefits, but it pains me when people turn down from their company that matching, because that was really free money that you said no to. If you are just on your own investing in an IRA, and you're saying, you know what, I just don't have the money because I am so new to the workforce, that's okay. You can let, the first couple years go by, but I would hate for you to then not 5 years out really start investing for it, because when we talked about that whole power of compounding and what it could actually mean, I think that if you look over, and I might be misquoting the stat that I read, but someone that invested, 5 years out at the maximum for, till retirement, and that was probably, what is it, 19,500. Every year consistently, when they got to retirement, they turned around and have, I think you have like $2.3 million. I mean, it's really an amazing amount of money when you actually think about all those years of investing and reinvesting, and that's just at, average market returns.
Mhm. We had somebody ask about whether you could comment on Bitcoin investing, and I recalled that recently your uptick discussed this, right? Yeah,
I did. Okay, so this is one of my favorite topics because I think that cryptocurrency and Bitcoin, it is fascinating, it is exciting, and you definitely, there's all this pull to saying like, oh, is this the next great thing? So here's what I'll tell you about Bitcoin investing. I actually think it is fun to take some of these new technologies and take a little, if you want to be involved in a very small way, I'm very comfortable with it, right? If you take a very small portion, you say, yeah, I bought a little Bitcoin. You have to also remember, you do not need to know Bitcoin is above $50,000 for a Bitcoin. You do not need to buy a full Bitcoin. You can actually go onto your PayPal account. You could buy $500 worth of Bitcoin right from PayPal, just so you have a little bit of skin in the game, because as I said, it's that teaching tool. You're going to read more articles about Bitcoin because you have a little money invested in it. And I think Bitcoin is either going to quadruple or it's going to be worth zero. And I don't think it's going to be anything in between. So here's the way I would approach it. If someone came up to you, rang your doorbell, and they said, I would love to pay you for your house right now, 20% more than it's even worth. The only problem is you have to accept it in Bitcoin, and you have to keep that Bitcoin for 5 years. Would you do it? Okay, so if you would say, yes, absolutely, I would do it, then I would say invest in Bitcoin. If you would say, get away from my front door, I would never take that offer, I want cash, you're not really, I don't know that you really truly believe in the long-term value of Bitcoin. Right now, if someone wanted to buy my apartment in Bitcoin, I would say, no, thank you, right? That's my biggest asset, and I'm not going to trade it for Bitcoin. Could I be wrong? Absolutely. Do I want a teeny piece in the game and buy a little bit of Bitcoin so I'm in the know and the flow and the excitement? I did.
I would probably say no also, but.
Okay.
Okay, Jamie, you mentioned that it would be okay to have a financial planner or a financial expert help you a little bit. Do you have a couple more? We've seen a few questions about just specifics on how you would go about researching or finding one, word of mouth, any other sources?
I do. I think word of mouth is very powerful. Your trusted friends are a great network of how to find that person that you're comfortable with. The only thing I would ask that you say to that person is, please don't I cannot give you my money and not understand what you're doing with it. Some people, when you see so much turnover in your portfolio and that people are getting fees for trading, you have to also realize that, when we go back to the mutual fund example, to know that most mutual funds don't beat the market, right? So you just have to know that. So make sure that your investment strategies are aligned. And you can also say, listen, I want to invest in companies for the long term. I'd like to be more involved in this process with you. I want someone to talk about these investments with, and not just the seeding control is really where I have a problem. And I think a lot of people don't pay attention to the fees in which they're paying. And those really, when you get this big report, you look at the returns, and on the surface, they look really good, but then you have to also contemplate how much you're losing in fees. But I'm not saying that having a financial planner is a bad thing. I'm not saying that at all. I'm just saying don't cede control and pay attention.
There were a number of comments about fee-based situations, I guess, where you don't end up losing a lot of the profit off of your investing, but you just pay them for advice. Yeah, you can definitely do that too. And again, what I would say to that is just make sure you use your voice. Sometimes the fees, if the fees on the transactions are very low, it could
be the same as the fees that you're paying. You just have to make sure that you look at fees no matter how they're divvied up. But trust me, people need to make money. That's their business. People are going to make money on your money. That's also okay if they're doing a great job for you, right? If they're doing a great job for you, that's the way they get paid. Makes complete sense. But just make sure you are asking the right questions.
Mhm, mhm.
Some people have asked tonight, I'm not familiar with Public. I just learned about that one today, but as an example, to watch for places where people are talking about where they're investing. So you're sort of like have an ear to the ground. And I mean, in some way it's watching which stocks are going up because those are the ones that people are investing in. But would you have suggestions of other sources?
Public is actually a great, interesting one that I actually might do something fun coming up soon to partner with them in some way. So I can I'll hopefully be able to share that with you soon. But it is a social platform where you could talk to other investors, as you invest, and also lets you do fractional share buying, which is great because some of the stocks that we know and love take an investment that's 1,200, right? So Shopify is a big one today that's up, maybe it's up 10% today, and Shopify really powers our online shopping. It's been an incredible stock throughout the pandemic, and a lot of people like Shopify because of the trends with how people are going to shop in the future. People think it's all going to be, now that there's so much comfort with online, that's going to continue to grow. But to own a share of Shopify, you need, over $1,200. So fractional ownership will allow you to buy, maybe you want to buy a quarter of a share of Shopify, and things like Public allow you to do that. So I think that's great. I think that social engagement around stocks is really important. Whether that comes on a platform or whether that comes in your everyday conversations with your friends and your peers, it would be great. The more we can get our friends engaged in talking about stocks, or maybe you get 5 friends together and all present a stock or do something fun in that way. But I think that the more we can get more engaged and bring our friends in, it becomes more fun. It's almost like, it's hard to talk about, and I'm trying to think of something fun. I'll give an example of, a royal wedding. If everybody watched it and then you wanted to talk about your friends, but if you're the only one, there's no fun to talk about and what do you think or comment about. If you're all on the same page and all doing it together, it becomes this fun thing that you all share. And it will get you a little more engaged. So yes, social platforms, but also try to pull your friends in.
Mhm. Also,
Like
somebody's
stock pick-
asking
Go ahead, Becky.
if you have any book recommendations.
Not as much as because I think that stock trading, and this is where I want to really impart that so much of it is driven by sentiment and not, a lot of books, because they have shelf life, are teaching you more of the how to look at stocks fundamentally, which is very important. And I think that is great. But so much of it is also that sentiment, and that way to really begin investing is to really get a gut for watching in real time how things trade and learning from that. What I will tell you to do, this is my best piece of media advice, is to, in the morning when you're getting ready, you turn on CNBC for like a few minutes. Every single day. It should be part of your routine. I know some people turn on the Today Show or Good Morning America. Please, take a few minutes and actually turn on CNBC every single day. My favorite show, if you want a recommendation, is 9 to 9:30. It's Squawk on the Street with Jim Cramer. You will pick up so much. It will be fascinating, and you can go on about your day, have it on in the background. You'll start to absorb. But best piece of kind of absorption, media advice would be to start there, and you'll find it very interesting. What they tell you about finance and Wall Street on mainstream TV is not, this is a journalist that's trying to relay, it's kind of like whisper down the lane, right? It's a journalist who heard something from someone else and now they're reporting back to you that, you know, I would love you to hear it directly from, you know, someone like a Jim Cramer who is an avid, passionate, and professional investor. And that's why I started my business, to have something that's readable instead of written by a journalist. I think it's very different, and I liken it to, you know, a surgeon. You know, if I were to explain a surgery to you and I'm not a doctor, you'd probably understand, and I'd probably get the high level, maybe the basics of it. But if you were to ask the surgeon would be able to give you a more detailed, thoughtful response. You would just hear from the tone and the way that they are described it, that you're like, oh, I get it now. That's what this person was trying to tell me. So that's why I would say go right to a real trusted news source sometimes for your financial information, instead of just reading from a journalist. And I see someone just talked about interest from cable personalities and conflicts. That's definitely true, but I think in terms of getting your basic news of what's happening in the stocks, everything that you see is definitely biased. They do tell you on CNBC when they own shares of something, so that you can actually, they're required to disclose that, you know, this person owns these stocks. So you'll know also, at least if they're influenced in that way. Somewhat helpful.
Thank you.
All right, well, wanting to be mindful that we are past 1 o'clock. I will say that one of my favorite people on CNBC, her name is Becky Quick, and I just love the name, and
Great.
she says great, she's very insightful too, but anyway, I had to add that. So thank you to all of the wealthy alums who joined us, and especially thank you to Jamie. You have packed so much into this hour. And we have saved the chat because alums were throwing out ideas all along and helping each other too, which we all love to see. And so we hope you will all subscribe to the Uptick to hear more. And just a huge thank you from all of us.
Great. Thank you so much. And thank you for your time this afternoon. And I appreciate it. And I love how many of you are so passionate about money, investing, and finance. It's great to see.